Okay, let's dive right in. We're going to talk about something, well, something that's at the very heart of business. Its value. See, for decades, we've had this one way, this one accepted method to figure that out. The one they teach in every single business school. But here's the kicker. What if that method is just wrong? Not just a little off, but fundamentally wrong for the vast majority of businesses out there. So let me ask you straight up. What's a business really worth? I mean, it sounds simple, right? A straightforward question. But the answer? Well, the answer you'd find in a textbook, it might be totally, completely disconnected from what's actually happening in the real world, especially when we're talking about a private company. Yep, that's right. Today, we are going to challenge some pretty big, long-held beliefs. You know that idea of a single true value? The one you spend hours learning to calculate in your corporate finance class? Well, it's time we put that whole idea under the microscope. And it all kicks off with what we can call the one value myth. This is an idea that's, deeply rooted in traditional finance theory. And the thing is, that theory, it's built for a very specific type of company, massive publicly traded corporations. So these old rules of finance, they paint a really simple picture, right? It's like there's one big market for money, there's one single theory that explains every business, every single company has one true value, and of course, the ultimate goal for everyone is to go public. But man, that worldview, it is just so incredibly narrow. And that's the real problem, isn't it? This whole framework, it's custom built for Wall Street. It's for the big guys, the IBMs, the Googles of the world. But what about everyone else? What about the local manufacturing plant down the road? Or that super successful software company that's privately owned? The family construction firm that's been around for generations? What about Main Street? And this brings us right to the heart of the matter. We're basically dealing with a tale of two markets, two completely different worlds. And the second we start treating them like they're the same, well, that's where all the trouble starts. There's a quote that just nails it perfectly. It says that public and private capital markets are simply not substitutes. You just can't swap one for the other. They're playing different games with different rules, different players, and honestly, completely different goals. And believe me, this divide is deep. Think about it. On Wall Street, the whole game is about maximizing profit for tons of shareholders. But on Main Street, it's about building personal wealth for the owner. You can sell a public stock in a second, but selling a private business, that could take years. They are just fundamentally different animals living in totally different worlds. Okay, so if the markets are so different, it stands to reason the money is different too, right? So what do the investors, the folks who actually put their money into private companies, not public stocks, what do they really expect to get back for their cash? To get our heads around that, we have to talk about a really key concept, the cost of capital. Now, don't let the term scare you. Put simply, it's the price of money. That's it. It's the return an investor looks at and says, okay, that's enough to convince me to put my cash into this business instead of all the thousands of other places I could put it. So, to get past all the theory and find out what's really happening, some researchers went straight to the source. They started this groundbreaking project called the Pepperdine Private Cost of Capital Survey, and their method was brilliant in its simplicity. They just asked thousands of real-world private investors, we're talking banks, private equity firms, venture capitalists, hey, what kind of return do you actually require? And let me tell you, the data they got back tells a powerful story. So on the low-risk end of the spectrum, you've got your banks, right? They're expecting a pretty modest return. But as the risk starts to climb for investors like private equity firms, that expected return just skyrockets. And then you get to high-risk venture capital. Whoa, it's dramatically higher still. And this isn't some academic theory. This is what the real market is actually demanding. I mean, this data, it completely changes the game. If the real price of money is this varied, then that one-size-fits-all formula from Wall Street, it's just broken. It doesn't work. We need a new tool, a new way of doing things, one that's built from the ground up, specifically for Main Street. And that new tool has a name. It's called the Private Cost of Capital Model, or PCOC for short. And it's exactly what it sounds like, an approach that's been built from scratch for the unique reality of Main Street. And the logic behind it is, well, it's refreshingly simple. Step 1, you stop pretending a company can just tap into the public markets. Instead, you identify who its real potential investors are. Is it a bank? Maybe a private equity group? Then, step 2, you use their actual return expectations, the data we just looked at, to figure out the company's value. It's brilliant because it bases the valuation on the market that actually truly exists for that specific business. Now, adopting this kind of mindset, this isn't just some small tweak or a minor adjustment. No way. It fundamentally changes everything: how we think about, how we measure, and ultimately, how we create value in private companies. Just think about it for a second. For years and years, appraisers would start with a public company's value, and then they'd slap on this subjective thing called a discount for illiquidity, which is basically a penalty because, you can't sell a private business on a dime. But wait a minute. If those private investors are already demanding super high returns because they know that risk is there, isn't that discount already baked into their numbers? You have to wonder, maybe that whole extra step is completely unnecessary? And you know what? The same thing goes for adding a control premium. That's when you add an extra chunk of value just because an investor is getting majority control. But here's the thing. Private equity firms expect to have control. That's part of the deal. It's one of the reasons they demand such a high return in the first place. So if we start using their real market data, maybe these arbitrary kind of made-up adjustments could just disappear. So what this all boils down to is this. We can finally stop using a ruler that's just irrelevant. We can stop measuring Main Street businesses with a Wall Street yardstick. This PCOC approach, it gives owners and their advisors a real practical tool, a way to understand what their company is actually worth to the investors who might really fund or buy it. And that helps them make much, much better decisions in their own real-world context. And in the end, it all comes down to one really powerful final question. If we keep valuing Main Street with a Wall Street ruler, what true potential have we been missing this whole time? I mean, for all the years we've been trying to force Main Street into a Wall Street box, what could we unlock for millions of businesses if we finally started measuring their value the right way?